Ladies and gentlemen, please welcome Warren Buffett, the renowned investor and CEO of Berkshire Hathaway. With his exceptional investment acumen and long-term perspective, Mr. Buffett has achieved remarkable success in the financial world. Today, he will share insights on intrinsic value, the significance of management in investment decisions, and address potential threats to Berkshire Hathaway. Get ready to gain valuable knowledge from one of the most respected figures in the investment community.
We're thrilled to be here.
We're delighted to have you.
Thank you. You earlier today discussed intrinsic value, and I'm a big fan of Graham and Fisher, especially security analysis. What differences do you have, if any, for calculating intrinsic value versus what was said in security analysis? And for example, how does management factor into that? You recently mentioned evaluating management is like dating. And recently, you said also, management does matter. My second part is, which company do you fear the most? Why is it that no one else has done what you have done? I mean, Coca-Cola has their Pepsi. Thank you.
Yeah, actually, Graham didn't get too specific about intrinsic value in terms of precise calculations, but intrinsic value has come to be equated with, and I think quite properly, with what you might call private business value. Now, I'm not sure who was the first one that came up with it, but, well, the first one that came up with it was ESOP, actually, but the intrinsic value of any business, if you could foresee the future perfectly, is the present value of all cash that will be ever distributed for that business between now and Judgment Day. And we're not perfect at estimating that, obviously, but that's what an investment or a business is all about. You put money in and you take money out.
Warren Buffett emphasizes that while Benjamin Graham's security analysis did not provide precise calculations for intrinsic value, it has come to be equated with what he calls private business value. Intrinsic value, according to Mr. Buffett, represents the present value of all future cash flows that will be distributed by a business. He acknowledges the challenges in accurately estimating these cash flows but asserts that it is the essence of investing. Furthermore, Mr. Buffett highlights the importance of evaluating management, comparing it to the process of dating. He believes that competent and trustworthy management is a crucial factor in successful investments. As for competition, Mr. Buffett does not fear any specific company, but acknowledges private equity firms as potential competitors due to their leverage advantage and borrowing capabilities. Nevertheless, he sees no one else attempting to replicate Berkshire Hathaway's unique model of acquiring wonderful businesses from owners invested in their success.
ESOP said a bird in the hand is worth two in the bush. Now, he said that around 600 BC or something like that, but that hasn't been improved on very much by the business professors now. Now, the question is, how sure are you that there are two in the bush? How far away is the bush? There are all kinds of things. What are interest rates? But, I mean, ESOP wanted to leave us something to play with over the next couple thousand years, so he didn't spell the whole thing out. But that's what intrinsic value essentially is. We don't. Graham would say that. Phil Fisher would say that. Phil Fisher would say that in calculating that, he would want to look a lot harder at the qualitative factors of the business in making that estimate of how many birds were in the bush. Graham would say he would want to see the bush, $2 worth of cash in the bush, and to pay $1 for it now. And one emphasized quantitative factors and one emphasized qualitative factors, but neither one would have disagreed with the math. And I started out very influenced by Graham, so I emphasized quantitative factors. Charlie came along and said I was all wrong, and that he'd learned more in law than I'd learned in financial studies and everything, and that I should think more about qualitative factors, and he was right. And Phil Fisher said the same thing. But that's That's what intrinsic value is about. If you buy a McDonald's franchise, if you buy General Motors, whatever it may be, the real question is, A, are you going to have to put more cash into it after you buy it? But it's really cash in, cash out, when, what discount rate, all the standard stuff.
Warren Buffett reflects on the timeless wisdom of the saying, "A bird in the hand is worth two in the bush," attributing it to ESOP from ancient times. He explains that intrinsic value is about assessing future cash flows and the need for additional capital injections after acquiring a business. While Benjamin Graham emphasized quantitative factors and Phil Fisher emphasized qualitative factors, both agreed on the importance of intrinsic value. Initially influenced by Graham, Buffett later recognized the significance of qualitative factors, a sentiment shared by Charlie Munger and Fisher. Intrinsic value involves evaluating the potential cash flows and considering factors like discount rates to determine the present value of an investment.
In terms of if I had a silver bullet, what company would I shoot as being a threat to us? I don't see any competitor to Berkshire. I see private equity buying lots of businesses and having an advantage in that they'll leverage up when we won't, and also that presently they can borrow money very cheap and all of that. So I mean, there are always going to be people competing with us to buy businesses, which is our main occupation for me and Charlie. But I don't see anybody that's got a model or trying to build a model that will essentially go after what we're trying to achieve, which is to buy wonderful businesses from people that care about where their business goes and who generally want to keep on running them.
In conclusion, Warren Buffett, the renowned speaker and CEO of Berkshire Hathaway, emphasizes the concept of intrinsic value, which represents the present value of all future cash flows of a business. While Benjamin Graham and Phil Fisher had different emphases on quantitative and qualitative factors, both acknowledged the importance of intrinsic value. Buffett recognizes the significance of evaluating management and considers it essential, comparing the process to dating. He doesn't fear any specific company as a threat to Berkshire Hathaway but acknowledges the competition from private equity firms. However, Buffett believes that no one else is pursuing the same model of acquiring wonderful businesses from owners who genuinely care about their success. This valuable insight from Warren Buffett provides profound guidance for investors.